Look, I'll quickly run through the highlights of the NOTA published on the weekend on AGL and Origin. So it's a very still a contentious space politically. The market has seemed to have relaxed a little bit, as reflected in AGL share price, on the risk of regulation. We've seen the so-called big stick legislation pushed back until at the earliest late March by the Senate. And we're still due to see the AER's draft bill on capped or default pricing in the retail space. Looking a little bit closer nearer term at FY19, so H1 19 interim results, I think both companies are probably likely to post in line with expectations. I don't think there'll be any major surprises there. I think revenue is probably going to be slightly down across both companies. We saw Origin's quarterly results, certainly indicating that in the energy markets division. And I expect to see slightly reduced energy markets results for AGL as well. Having said that, though, AGL do have a fairly substantial cost out program ongoing. So depending on the timing of that, we may see some of that flow through into EBITDA margins being a little bit higher than PCP. Likewise with Origin, we should see a boost to EBITDA given the way that they account for their APLNG investment. So rather than seeing the strong oil price reflected in revenue from H1 19, we're probably likely to see that in EBITDA. So keep an eye out for those two. Like I said, I don't see any major surprises coming. But AGL, I think, is an interesting stock. I've reiterated my reduce rating on that one. I've updated my price target to $18.02. So that's off the back of updated electricity price assumptions. So we saw some modelling released by the AMC and EY in late December, which indicates that we are likely to see some pretty heavy falls in the spot price over the next few years in FY20 and 21 in particular. But that's offset by a slower or much more moderate fall in retail pricing. Now, as AGL is pretty strongly vertically integrated and the retail price is not forecast to drop significantly, it's probably not as dire as I predicted back in October, November last year. Having said that, though, those headwinds do look pretty substantial. So I think it's going to be a tough one. I find it tough to pick actually the timing of this one. I think on a 12 to 18 month basis, it looks like a reduce. But as I said, the interim probably looks reasonable. So you're likely to see strong dividends this half and potentially for full year. But I am still concerned about what happens with the regulation that may come in around the time of the election, as well as what guidance for FY20 might represent. So I'm going to leave the timing on that one to you guys to determine whether you want to stay in there a little bit longer or whether, if the AMC's modelling is correct, whether you want to be in there long term or not I think is questionable. On Origin Energy, I still think this one's a little bit oversold. It seems to have been treated with the worst of both of their big business divisions. So it's been sold off on the back of some of that concern about electricity market regulation as well as the volatile oil price. And I think the market went a little bit too hard given that for FY19 at least, there's some pretty substantial hedging in place to limit the downside with the APLNG business. And I think moving forward, Origin is probably positioned to navigate a higher market share with renewables to share that space a little bit better, given that they've got a tilt in their generation fleet towards peaking. So just to reiterate, I've kept the recommendations the same. The price targets have been updated with a bit of a lift for AGL, and the timing, I think, as I said, is going to be challenging with the first half results reasonable, but guidance for next year, I think, is questionable.